I mean, I titled my musings on Friday "Gut Punch" to kind of relate to the idea that the belly of the curve on Friday really moved aggressively, and that typically, you know, when you get punched, or like I played American football, when you got hit in the head really hard, you see stars, right? And after a while, you know, like a minute or so, whatever, the stars go away. And so I kind of use the stars and replace them with dots. You know, we got punched in the belly with the Fed commentary, and investors saw dots, moving dots, and it got everybody out of whack. And to me, I think it's a big mistake to really spend much time thinking about the dots. It's just purely governors' opinions on where rates might be in a year and a half to 2 years down the road. It's not a binding forecast. It's nothing more than like a you know, finger in the air to see which way the wind is blowing, and is subjected to change at any point. And I think it's also even more so the case in this instance to not really pay much attention to the dot plot. Here, the dots are being put in place during a time of maximum price volatility in terms of the CPI, as we've talked about for weeks and weeks now, several lives. The recent inflation numbers are very distorted by the base effect stemming from COVID's you know, economic induced collapse last spring. So those numbers are now gone, right? When we go into June next month, when we look at June's inflation number, it's going to show a significant decline, at least in the year-over-year number, relative to May's number, because that base case effect falls out. So to me, I think it's I've never been a fan of the dot plot. I think this is probably going to go down in history as a perfect example of why you shouldn't pay attention to the dot plot. The Fed is leaning towards tightening at a time when growth is already slowing. And so we don't want to see rates go lower. Actually, and so now we need to think about higher interest rates are bullish, right? They'll restore the thought about the value trade. They'll remove the concern about a growth slowdown and a Fed policy mistake, because the policy mistake discussion definitely kind of materialized over the weekend. The policy mistake is that one, that the Fed is been spooked by the spike of the last couple months, which is we already talked about, is no longer valid because the base case effect is falling out of the CPI. But nonetheless, the dot plot was made during a time when when inflation spiked, freaked out the governors. They made their dot plot. That in turn freaked out the market. The Fed is now leaning in everyone's mind towards tightening at a time when underneath all of this, there's a sense that maybe U.S. growth is slowing, or certainly has peaked. Q2 is going to be the peak in growth for the United States year over year. The question is what happens next. Now, naturally, since we're growing at 7% per annum and we're a large, mature industrial economy, we're not going to sustain that. So it's a natural deceleration. The question is to like what level? And I would just note, and this is research I did over the weekend, ECRI, which is one of the leading economic forecasting companies in the United States, came out saying that there is a growth rate cycle slowdown coming into view in the United States. Now, they don't put a number on what that slowdown is. And so to me, again, it's this kind of uncertainty of the environment that we're in, that clearly we're going to slow. And then whether growth is 7% in 2021, going to be 3% or so in 2022, obviously that's a slowdown. Fiscal stimulus, which is somewhere around 10 to 15% of GDP last year and this year, is going to slow to like 2% next year. So the fiscal side is going to be a drag on a relative basis. And so all these things coming together, and by the way, ECRI also points out that what happens following a growth cycle slowdown, an inflation cycle slowdown, comes shortly thereafter. Again, with a lag, but So that would argue to me that this inflation fear, which I've never really, I'm a transitory guy. I've never been a buyer that we're going into a permanently higher plane of inflation, or one that's going to be worrisome. I actually think that 2% inflation for a couple of years would be a very good thing for the United States, as well as for Europe to have higher inflation.
Yeah.
The issue is not inflation's too high. The issue has been that we have not been able to get the economy going to a strong enough level that we would have inflation. And as we all know, or should definitely remember, when you have a lot of debt, you want to have inflation. I took a look at how long the House and Senate are in session for the next several months, and this is vacation time all around the world, or at least the U.S. and Europe, and for sure Congress is going to be on vacation. So listen to this: in between basically the next week and Labor Day, which is in early September, the Senate is going to be in session for 16 days out of the next 2+ months. And the House is going to be in session for only 9 days over the next couple of months. So, I mean, doing the people's work they don't seem to be doing too much work in this. This obviously is going to complicate the passage of the jobs plan. And it does look like the idea is to split the two packages, or to have two packages. One, the infrastructure, potentially via a bipartisan bill, and then the second larger kind of family plan is likely to be done via reconciliation. And so there's an awful lot of moving pieces, not a lot of time. And right now, the concern is that the economy is running so hot that we don't need stimulus. I think it's going to be it's quite possible to think in 2 months, it's going to be seen as almost critical to averting a significant U.S. slowdown. So all that suggests, obviously, that there's a lot of moving pieces, and people are going to have to pay attention as we go forward. So what I would say about commodities is that they had been red hot. Now they're just the latest little bubblet to be pricked by this market. And we've talked about this as well for months and months. This market has been extremely efficient and effective at pricking any little bubble that kind of starts to expand. And you talk about the FANG stocks from last fall, GameStop and the meme stocks, or the meme stocks in January and February. Talk about crypto, talk about commodities of late. So to me, that's healthy. We want these pullbacks because we're early in what I think is going to be, multi-year moves on non-U.S. equity, on value, on commodities. I think we're in the beginning of a super cycle in commodities. And so it's actually healthy that we have these pullbacks every once in a while. They may be a little bit painful, but I think they're healthy because they're going to provide us kind of the lockstep to go higher. So as I wrote again a couple of weeks ago, I think in the monthly second half outlook, the pause that refreshes, we want to be sure not to get shaken out of these long-term trends by short-term volatility. So one of the challenges to be an investor today is these moves, these sell-offs come super fast. And mostly because the trading day-to-day is done by algorithms and by machines. And so as a mere human, I don't think we want to try and trade those and try to outfox the machine. I think that's a losing game. I think the winning game is to be, properly positioned and sized in your allocations and your exposure, and having themes and views that you are able to kind of stay with. And when things run, you take little profits off the top and reallocate elsewhere. to me, I think you have a situation where commodities are likely to be, as I say, in a multi-year super cycle for all sorts of reasons having to do with the push to clean energy, ESG related concerns around financing, the time it takes to bring supply on line for commodities, et cetera, et cetera. So to me, that's an area of opportunity when you get pullbacks. Yeah, the dollar again is somewhat tricky. I've been in the weak dollar camp with the view that we're going to go to that synchronized global recovery. That means the rest of the world is going to capital is going to flow to the rest of the world. That's dollar bearish. So the last couple of days on that front were not great, but it's been an aggressive move. The dollar's been up actually, I think 5 of the last 6 weeks, DXY. And I believe the move, the 5-day move that ran through Friday was the second or third most aggressive move in the last 5 years. Just to put that into context. I mean, it was a really pretty aggressive move. And I think part of that is simply the short covering because there are a lot of dollar shorts out there. And I think that kind of super fast reaction, aggressive reaction speaks to me of people being off sides and having to get onside real quick, and there you go. You've seen it. But I think to me, I'm watching, and as I've said before, and we've talked about on the lives here, the technicals are important, right? In these markets, technical levels are important. And for me, I'm watching like 93.50 or so on the DXY as an important level. If it gets above that, that suggests, at least according to folks who are more technically driven than me, that would suggest that the DXY may have some more room to go to the strong side. My own feeling is that this was, again, a positioning issue. There were a lot of dollar shorts. They got toasted. They had to get out. And therefore, we had the dollar have one of the biggest moves it's had in the last 5 years. Yet the fundamentals do not really support that move, and particularly if we're right in suggesting that inflation is not going to continue to skyrocket, that growth in the U.S. is peaking and is going to start to decelerate, and therefore this idea that you could buy the dollar because the Fed's going to be more aggressive than other central banks, I just think it's so far away that it doesn't really that thesis doesn't resonate with me. So I've never been my view has been that the dollar weakness is more against things like the Brazilian real, right? Which I'd note again today had a pretty big up day and back to right around 5 on the dollar. And, it's probably going to chop around 5 because that's a big round number. But most fair value estimates that I see for the real versus the dollar are around 450 to 420. I don't see any reason why, that's not likely to happen in the next 6 to 12 months. So we've had a big move from 575 to 5, and now we chop around a little bit. But I don't see a lot of downside risk to the real. We obviously know the central bank is tightening and is likely to continue to tighten. We know growth cycle is picking up. We know there's the commodity demand that we talked about earlier. There's a big drought in Brazil, as I don't need to tell you or the folks on the call. But that's obviously going to have an impact on things. So to me, it's not so much that the euro is going to appreciate dramatically or the yen is going to appreciate dramatically. It's more that I think there's some opportunity in some of the emerging market FX that got pretty badly oversold over the last year or so. No, I think you encapsulated them well, right? It's the physical price pressure of commodities versus the digitalization of everything, and it's it's important to note that there are some arguments that the potential for a productivity surge in the U.S. is really starting to manifest itself, and partly driven by the acceleration of COVID, right? The COVID speed argument that we've talked about for months and months. So I think there is, look, we want, again, we want more people in the United States to make more money, right? The problem has been that there have been, some people making a lot of money and a lot of people not making very much. And that needs to be kind of addressed. And I think hopefully that will be addressed as we move forward. But we want to see people in the low earning wage groups in those jobs. We want people to get paid more money. And that's a big part of, the policy approach of the Biden administration to focus on income equality, to focus on, it's not a great word, but redistribution, and kind of smooth out some of the economic imbalances that have manifested over the last decade, and which are still manifesting, because as we know very well, the financial folks in the financial industry, or who are investors, have done great. And this is an important point in the sense that the net worth of people in the United States has really done extremely well over the last year or so, because not only have stock prices gone higher, but house prices have gone higher as well. So for the majority of Americans, and this is important to think about when you hear about quit rates and people not rushing to go back to work, the majority of Americans, these being people who have financial investments and who own their homes, and that's not everybody, but those who do, both of those things have done well. So the net worth and net wealth position of the average American consumer is better than it's been probably in decades, if not record in terms of its how strong that is. And so that's another point to keep in mind. But to me, the idea of we're going into wage cycle inflation, we still have 10 million unemployed Americans, and so I think we're way far away from that. Right? We got down to 3.5% unemployment before COVID, with no sign of wage inflation. And we're right now at what, 5.8% unemployment. So again, in 18 months, 24 months, we can have that discussion and see where we're at. But to kind of, and this is again going back to the dot plot where we started, to decide policy or investment positioning based off of random guesses about where inflation is going to be in 2 years is just, I don't think it's worth doing. I think it's a mistake. And investors need to have an understanding of how and where the world is going. And I think you're absolutely right. And I'll finish here that, China has been elevated in the US to a strategic competitor. So it's no surprise that we're starting to mimic them a little bit with kind of the industrial policy. Europe clearly, as we've talked about before, is the best positioned, I believe, the best positioned of the three main regions, Asia, Europe, and the Americas, in terms of its medium-term outlook because of the Joint Recovery Fund, which is just now starting to disperse funds. And so for the 2021 second half, or 2022 to 2025, Europe is actually probably in the best position because it's already set. Their medium term is already set. Where the US, we still have to get through all the things we just talked about. And so I think you're absolutely right. Industrial policy, public-private partnership, more guidance by government as to CapEx and investment and spending and research, et cetera. All of that is part and parcel of the environment. It's very much along the lines of regional integration, right, in the tripolar world. And B, it also is somewhat reflective of the need to deal with China as a strategic competitor. And then C, it really resonates with the idea of trying to improve a more equitable, inclusive economic growth profile for America as a whole, not just for certain segments of the population. And so that's where I think the opportunities are in Japan. I think in Latin America, we've talked about it. One of the biggest positions in the model portfolio, in the multi-asset one, not thematic, is Latin American equity. And I'll note that one of the two big firms, I forget whether it's JPM or Morgan Stanley, just upgraded Mexico and Brazil. Others have done the same thing. It's one of our single biggest equity positions. And I think we're early in that process. And by the way, Latin American equities held up very well last week, very well. Almost, broke the 20-day moving average, but didn't come close to threatening the 50-day or the 80-day. And they've had a big move. They're one of the big winners of the last 6 weeks or so. So that, again, tells me that people are not really invested there and don't want to sell, and are waiting for the reattachment of Brazilian equities, for example, to the commodity cycle, and want to see that as an opportunity to go higher. And so in emerging markets, the opportunity set, as I see it, is primarily in Latin America. To me, it's very simple. I just look at the mortgage applications. That's the leading indicator to housing, and they rolled over months ago. So, the demand for mortgages, for financing, has ebbed considerably. So again, the idea that we're in a housing bubble is just doesn't make any sense. Yes, houses in certain places, namely suburban locations outside of major cities, have got a serious bid to them because people post-COVID or during COVID have wanted to be out in the countryside. But that's already changed. And so naturally, when you have higher prices and fewer houses, right, the inventory has gone way down. That therefore it puts housing out of reach for certain people, and therefore the demand slows. And that's where we're at. And you can just see it with lumber, right? Again, lumber, is down 40%. From its peak of like 2 or 3 weeks ago. So this is that's kind of a confirming signal that this idea of a housing bubble is inaccurate, and therefore is not something to really worry about. I'm just the relationship between mortgage applications and housing is pretty well known, and yet it seems as if with COVID, and the story is too sexy. The story is too interesting to hear about. The cities are dead. I'm in New York City, right? All I've read about for the last year is that New York City is dead. And I've been here the entire year, and I can assure you it's not dead. And it's most definitely not dead now. But, it's such an easy story. Cities are dead. Suburban country living is where it's at. And everybody wants to buy the house. If you're at all thoughtful, you would not be buying the house in the countryside now, because they're up 20, 30% versus what they were a year ago. And probably a year from now, if you try to sell your house that you bought at a 30% premium, you're probably going to have to sell it at a 20% discount, because that 30% premium is artificial. It was just driven by COVID. It's not real and not sustainable. So I don't see housing in a bubble. To me, as I said, the opportunity that's exciting is that you can, are we going to be able to push the U.S. economy and the European economy into an above trend growth path? And if we're able to do that, and if the trade is to have inflation run hot, i.e. like 2% or 2.5%, not 5%, but run hot for a period of time, that's a trade I would think as investors we would want to take all day long. That is historically quite good for equities. And so rates in that environment have to go up. And as I said at the beginning, and I know we're closing, so maybe we'll circle back and end where we started. We don't want to see rates in the U.S. decline from here.